All right, good Thursday afternoon, investors and traders. Welcome to Phenom Group's weekly State of the Market. I'm your host, as always, Seth Golden. It is Thursday, so let us check in real quickly because we know that in 2022, the market has not favored Thursday. I think it is the worst, holds the worst returns of the year, although for 2 consecutive weeks, the S&P 500 has been up on Thursday, and we'll get to those 2 weeks that had just passed. And here we are again, kind of reverting to our old ways so far as the market not liking Thursday. But at 2:30, we still have an hour and a half to go. So we'll see where we finish a little bit later on. Anyways, let's jump right into things because we got a lot of studies to go over this week. We got a lot of catching up to do and very little time to do so. I hope everybody is trying to get back on track here in 2022. We at our trough, we were down 14.5% in the S&P 500, 22.5% in the Nasdaq. But this, the prior 2-week period, we saw the S&P 500 rally 11%. We saw the Nasdaq rally 13% off with lows. And at one point, we were only 3.5% down for the year on the S&P 500. As I've been saying all year long, we've expected this kind of turbulence, this kind of back and forth action, even said that we're probably going to be range bound for the better part of this year, given that it's a midterm election year. We typically don't see a material lift in markets for the average midterm year until the Q4 period. As always, you throw into the mix Fed rate hikes, inflation, and the war in Ukraine, and you've got this state of uncertainty that is going to persist for some time. There are offsets, as you probably have already heard, so far as stemming some of this inflation ramp already here through the first quarter of 2022. The White House administration is contemplating tapping the strategic petroleum reserve for another 1 million barrels a day. To put that into context, recall that at the most recent OPEC Plus meeting, they decided that they were going to expand their production capacity by 400,000 barrels a day. So in terms of what the White House administration is talking about and the SPR, Strategic Petroleum Reserve, that's 1 million barrels. That's twice what OPEC aims to increase so far as capacity. That's how threatening the situation is so far as just the supplies when it comes to crude oil. But for every con, there's a pro, and for every pro, there's a con. We tend to live in this world of media hyperbole where they only focus on the cons, the headwinds, the potential for economic calamity, at the very least an economic slowdown, and they fail to recognize that there are offsets. Where there's a will, there's a way. Where there's a problem, there's a solution. But we'll see how this progresses. Anyway, jumping into our weekly State of the Market. As you can see here, wars stressing global supply chains, inflation rises, yet the S&P 500 went risk on over the last 2 weeks. Some are saying this is madness, a fake pump. Stocks are divorced from reality. Here's the problem with that. Stocks are only divorced from your reality. The S&P 500 doesn't adjust to you, what you want, what you like, what you think is appropriate. You have to adjust to the S&P 500. If your game plan wasn't already in accordance with the volatility, the expectation that has become realized here in 2022. The S&P 500 doesn't adjust to you. The markets don't adjust to you. You have to adjust to them. All right. The volatility box that we've talked about in pretty much all of March. And this is where we started on March 4th. We had bounced off of here. We actually retested. Talked about that. And what we wanted to see happen, if you're bullish, of course, is that we wanted to break to the upside as opposed to, bounce, here we are testing it twice, just like we tested the top of the box twice here, tested twice here, and we broke to the upside. This is very different than what happened in 2018, right? And we talked about the trading range right here. While I was not of the opinion that the lows were in for the year, and since the former low of 42.22, I'm finding it more difficult to believe we haven't seen an interim low this past week. I remain open-minded to new lows after a 14.5% correction, but with earnings still expected to grow 9 to 10% in 2022, a trading range from here of 41.14 to 4,600 may prove the more likely outcome over the coming months. Over this period of time, it is necessary for stocks to stop going down before they can start going up. Furthermore, the absence of weakness is not sufficient condition for strength. So here we are. We got up to 4,600. We broke above. I think we hit 4,630 or so on, I want to say Tuesday. Yeah, on Tuesday. But then yesterday we had some consolidation, right? This was an 11% move, folks, to break out of the volatility box. We're not likely to go up in a straight line from that point. More than likely, and into the quarter end, into the month end, this is the last trading day of the month and quarter, it was likely we were going to see some consolidation. Indexes pulled back a little bit yesterday. Indexes are pulling back a little bit today. But investor takeaway for this chart and for this volatility box is that unlike 2018, we did not break to the downside, we broke to the upside. Remember, usually when you test a resistance level a third time or a support level a third time, you break through. And we did to the upside. From here, it's about fun. Yeah, we had good breath, and we'll get into that as well. We've talked about finding bottoms till we're blue in the face, just like in the S&P 500 broke out. So it made a higher low. That's essentially what this is, right? All this while we were making lower highs, lower highs, lower highs. This is a higher low. That's a good thing. That's what we want to see. Did we see it in the Nasdaq? This is the Nasdaq composite, just like the S&P 500 tested resistance twice back in February, tested support down here twice, and eventually broke and made a higher low on the same day that the S&P 500 did. So in terms of finding bottoms, a higher low was achieved, checking the boxes, a higher low was achieved on 329. Before that, we had to reclaim the 10-day moving average. Then we had to reclaim the 20-day exponential moving average, check. We needed a follow-through day of a 1.5% gain on day 4 or later, after you've had like a reversal day. So here was the bottom, day 1, day 2, day 3, day 4. Doesn't get any more perfect than that, folks. 1.5% or greater move in the Nasdaq, right there. We made it happen. That was on 3/2. The S&P 500 did it on 3/18. New leadership. Do we have that? That's part of our checklist so far as finding bottoms. Indeed, we do. Growth, tech, Nasdaq, they led the way. They had bigger gains. You could also say that utilities also led. They haven't been leading this year, although energy has been the leader, followed by the more defensive sectors like consumer staples, utilities, and healthcare. But full-scale leadership in utilities now as well. In order for these to not prove bottoms at this point, and since we've made a higher low and reclaimed all of our moving averages, even the 50-day moving average, we need something to press macro fundamentals. And more than likely, we would need to see earnings growth deterioration. Other than that, technically, we should stay in a trading range, but test the upper bounds of a trading range, maybe test the lower bounds of the trading range as well over the next couple of months. But as long as earnings don't deteriorate, we should find even higher prices. We talked about this chart. This was the percent of stocks trading above their 20-day moving average in the Nasdaq. This study right here, since we reclaimed the 20-day, we also reclaimed the 50-day moving average in the Nasdaq 100. This was the Nasdaq 100 as well, folks. Nasdaq 100. This is a chart we looked at where 95% of stocks got above their 20-day moving average. It's a really good signal. Prior signal dates where this occurred, 2003. Early 2009 was a little bit of a misfire. 2010, what happened after 2010? Market went higher. 2013, what happened after that signal? Market went higher. After July of 2016, market went higher. Here it is in January of 2019, it fired, market went higher. You get the point, right? In April of 2020, after the March 2020 bottom, we had this signal fire, market went higher. So that's the 20-day moving average occurrences. We did go higher after that fired. And then we reclaimed the 50-day moving average for the majority of NASDAQ 100 stocks. So this chart shows you that we went from less than 20%. Here's 20% of NASDAQ 100 stocks that were trading above their 50-day moving average. We had less than 20% of them. We quickly, within 10 days, folks, 10 days, had more than 60% of NASDAQ 100 stocks trading above their 50-day moving average. Yes, that's a thrust. That's a pretty good breath thrust. So we looked at this study here. What happens after the percentage of NASDAQ 100 component stocks above their 50-day moving average from below 20% to above 60% in just 10 days? 1 month later, the average return, 3.8%. How many times has it happened? Going all the way back to 1996, 15 times. That's a good sample size. And it's a good, duration. So average return 1 month later for the NASDAQ 100, that's pretty good. 73% positivity rate. 3 months later, 6 months later, 1 year later, folks, stick with the market, as I always say. And as you've seen, if you got out of the market, earlier in March, or if you moved to cash, or if you started hedging, that just didn't work. And it would have been just easier. Just stick with your positions and watch the rebound. Again, we weren't going into a recession. We're still not. We don't see a recession on the horizon unless something breaks. Even with all these headwinds, stick with the market. Anyways, a year later after this signal, folks, 26.6% higher, 87% positivity rate. Average drawdowns are in these rows down here, 4.3%. Can you live with that over the next month? If you can, good, because this is your reward. 6.6% over a 3-month period is the average drawdown. Can you live with it? Good, because this is your reward. You get the picture. All right, what else? Drawdowns have occurred within 1 year frame, but they've all been proven by the dip opportunities 1 year out, folks. All right, here's another study right here. So I ran events when the percentage of volume, this is a volume study of the advancing declining NASDAQ 100 stocks when they went from negative 90% volume to above 90% volume in just 3 days. So negative 90% advanced declining volume to a positive 90% advancing decline volume, going all the way back to 1997. And it happened on 311 to 315. On 311, we had negative 91% advancers versus declining volume. On 315, we had 92% advancing volume. The forward one-year returns were positive 98% of the time, folks. That's this right here, 98% of the time. In the final tally, the average return was 28.3%. Like 3 days, like something happened clearly to shift investor risk appetite in the Nasdaq 100. How many occurrences? 45 observations. Again, this goes back to 1996. So far, so good, right? Okay. Next study. All right, today, March 31st, final trading day of the quarter and the month. If, and it seems likely unless something blows up here today, because we're only down 0.5% or so on the S&P 500. So if the S&P 500 can manage to finish the month of March higher by 3% or greater, after being down 4% or worse earlier in the month, then this is the precedent following this sort of bullish reversal month. This study here by Steve Depp, we're up 5 point, coming into today, we were up 5.22%. So we would have to lose 2.2% today to not fire this signal in this study here. And you can see 1 month later, 80% of the time the market is higher by 2.7% on average. 2 months later, it's a lot of white. That means the market's higher. There's very little red. Going out 12 months, the market is higher 93.33% of the time, folks. The average gain, 21% for the S&P 500. Wonder if it did. It happened in 1982. Go figure. Go figure, right? There's our 1982 analog again. And yes, we are still on track. There's a little bit of a deviation right now because, well, no, we are on track. This week, we are supposed to consolidate into the end of the month, and then we take off into April in 1982 if the analog is going to stay its course. So far, we are consolidating this week into the end of the month, into the end of the quarter. Let's see if we can take off just like we did in April of 1982. Let's see here. 86.6% of the S&P 500 stocks are trading above their 20-day moving average. That was on March 23rd. And historically, that's not enough to give you kind of a breath thrust signal. You have to be greater than 91%. But again, this was as of March 23rd that I checked it. And don't get me wrong, this is still fantastic. Move off of the lows. Clearly, 86% of stocks are participating. But then I checked it on March 29th, 2 days ago, we were at 94%. Hence, we've got our signal. We needed to get greater than 91% of S&P 500 stocks trading above their 20-day exponential moving average. So when that happens, here's our study. S&P 500 forward returns after 93% of the components are above their 20. We were at 94%. So over the last 20 years, it's happened 26 times. The average, this tells you, might get some these are weeks. These are not months. So these are weeks. So you might get some near-term, consolidation. It's a big move we had in the S&P 500, folks. The average return is negative 1 week later. Here we are, right? So we're getting some consolidation. 2 weeks later, the average return is also negative. These aren't big drawdowns. And it's kind of a toss-up, right? And the 50% positivity rate, it's a toss-up. 3 weeks later, though, 77% of the time, the S&P 500 is higher. 1 month later, 65% of the time. 3 months later, gains are looking good, 81%. So 3 months later, April, May, we're into June. But Fed rate hikes, but okay, I hear you. We'll see. Trust me. The Fed was hiking rates over the last 20 years, folks. The Fed was hiking since December of 2015. This happened in 2015. This happened in 2016. This happened in 2018, just after the Christmas Eve massacre when we came back, the first trading day, and we were off into the new year. So this happened then as well. Think longer term, as they say. The S&P 500 10-day advanced decline line since 1990. Look at this. The S&P 500 was up 11% in 11 days. Only other times it gained at least 10.5% recently: November 2020, April 2020, 2011, 2009, and March 2009. And we know that after these dates, the market was higher every single time. So at Monday's high and through Wednesday, despite the decline yesterday, the 10-day advanced decline line reached the most elevated level since October 2020. It was in the 96th percentile. So when we look at this heat map here, technically you usually don't want it that high. When the lower you are, the better the returns are going forward. See, when you're in the lower percentiles, you've got darker green returns going out. When you're in this middle area, you got a lot of lighter shaded greens here, and even another shade somebody will have to understand better than I can because it's blending on me here. But then when you go to the extreme, so if you're at the extreme low and the extreme high percentile, like we are now, 96th percentile, so we're down here with the 10-day advanced decline line, right? We've moved 11% in 10 days or 11 days. 95 to 100 percentile, the 1 week return, not bad. 1 month, 3 months, percent of the time positive increases pretty much throughout as well. The 1 week is, iffy, just like in the previous study we looked at. But once you get past that 1 week, 1 month later, positivity rate improves, so do the returns. Here's the thing I want you to take away, because you probably heard and seen all of this, oh, it's a bear market rally nonsense, it's a dead cat bounce, we're going into a recession. Well, then how do you get this many stocks trading above moving averages, and especially on the Nasdaq 100? From less than 20% of stocks trading above their 50-day moving average to 75 at one point before the little check back here. That's a goodly amount of stocks, folks. Now, if it was just a handful of stocks, if it was just FanMag or large cap growth stocks, then I'd say, yeah, because they could lift the market by themselves. And then you might have a less durable rally. And clearly, none of these breadth thrusts that we're talking about would have signaled. But that's not the case. And that's my point. It's not a fake pump. It's not a dead cat bounce. You wouldn't have this kind of participation if it was. It's a real rally. It doesn't mean it can't give way to another decline, even go back into correction territory. That's not what I'm saying. What I'm saying is not fake. It's real. As we discussed at the top of our weekly research report, when somebody says that stocks are divorced from reality, they're usually just hinting at their bias. Here's the problem with that. Stocks are only divorced from their reality. They're failing to contemplate, if not calculate, what's going on with market breadth. All right, let's talk about April, since tomorrow is first trading day of the month. Here we go. And April, as you can see here, no matter what you're looking at, since 1950, past 20 years, past 10 years, and midterm years. Midterm years are the worst. That's the little candle here, unfortunately. But positive on average over the last 20, 10 midterm years, and since 1950, in fact, the best. Here's the midterm year chart. You can look at, so here's March, here's April, end of March, April. But then, and we know, we've discussed this, usually you don't make a low in a midterm year until the second half of the year, if not the third quarter. And you get a really steep rebound after the election. Hence, off to the races. So that's our midterm years, which tend to be weak into Q3. And that's why I say, even though we've had this fantastic rally, no, I haven't changed my tune. I don't think the lows are in for the year. However, I am positioned bullish. I'm willing to take my drawdowns. I've got the cash on the sidelines. I was up 1% as of yesterday, folks. As of yesterday, because I was buying the dip, selling the rip, rebalancing my portfolio into the end of the quarter. But imagine if I tried to fool around with hedges, took some losses down there when the markets were down double digits. Stick with the market. The market is going to have these rips and dips, I believe, through the third quarter period. This year is the fifth worst start for S&P 500 since 1927. Markets have been absorbing significant macro and geopolitical shocks, including higher and more persistent inflation, amid an aggressive central bank pivot. This is from J.P. Morgan. They adjusted their 2022 S&P 500 EPS estimate from 240 to 235, and they've adjusted their S&P 500 price target from 50.50 down to 4,900. Our EPS estimate coming into the year just so happened to be the same at 240. We're not lowering our Phenom Group earnings per share estimate at this stage. We will have to see and hear from corporate executives during the earnings season before we do. And we got to calculate the actual results. We are still seeing earnings estimates moving higher for the first quarter, second quarter, third quarter, and full year. And that just happened over the last couple weeks. Go figure, the market rallied, found its base, and it rallied in accordance with earnings estimates moving higher. This is also from Barclays. They lowered their S&P 500 forecast as well, or price target, from 4,800 to 4,500. They also reduced their earnings per share estimate from 235 to 223 a share. Who else? Goldman Sachs lowered their price target for the S&P 500. They were at, I think, 5,100. They knocked it down to 4,700. Goldman Sachs chief equity strategist David Kostin slashed the firm's forecast for the S&P 500 EPS, which is now 233. Price target 4,700 by the end of 2022. Former price target was 5,000, sorry. Who else? Ed Yardeni. Investors panic easily. Remember this? He knocked his all the way down to 4,000. He knocked his S&P 500 price target all the way down to 4,000, folks. For the U.S. economy, we now see stagflation with persistently higher inflation and less economic growth than expected before the war. I followed Ed Yardeni for a number of years. I respect what he says. I disagree at this point. We'll see how it goes. Credit Suisse's Jonathan Golub, no change. He has a price target, 5,200. He's sticking with it. Deutsche Bank's Binky Chada has a 5,250 price target, and he's sticking with it. BMO's Brian Belsky, 5,300 price target. He's sticking by that. So this is kind of funny to me because I followed David Rosenberg for a number of years. He's a big perma bear. The date on this is March 16th, which pretty much the lows, right? Prepare for a recession this summer, a bear market in real estate, and a drop in stock prices, warned strategist David Rosenberg, March 16th. Don't you love when the perma bears become this confident with their outlook? And then all of a sudden markets rip. And that's usually what they like to do, make as many people look as foolish as possible. And people got as bearish as that's why I say, don't get overly, bullish, don't get overly bearish, just try to maintain an equal, a sound footing, just equilibrium with your emotional quotient. The S&P 500, this is the newsletters, the Bull Bear newsletter survey. A few weeks ago, the number of bearish newsletters topped the number of bullish ones for the first time since 2020, April 2020. How the Investors Intelligence Sentiment Survey has performed as an indicator, using the value of the percentage of bullish newsletters minus the percentage of bearish newsletters, we separated the weekly results into deciles. Green cells are those that beat the overall average for that time frame, while pink cells underperform the overall average. And we got, into the lows. Let's see. The top of the table, so the top here, 0 to 10, the top of the table corresponds to low readings, very bearish, which means the newsletters are relatively bearish compared to rows farther down the table. They tend to be very bullish. So when they're more bearish, going out 4 weeks, you have good returns. When they're too bullish, going out 4 weeks, 8 weeks, you have negative returns on average and since 1972. And we got negative as you can get. And lo and behold, when people are leaning to that side of the boat, too heavily to one side of the boat, guess what happens? They rock it, and all of a sudden we have a reversal. We did invert the yield curve to kind of segue into a new topic. I'm sure you've already heard. It's all over the news feeds. It's all anybody can talk about is the yield curve inverting. And we've talked about it in the past, just kind of set our psychology, understand what the probabilities are for the S&P 500 going forward once the yield curve inverts. Now, this is only looking at the last 4 yield curve inversions, but the bull market didn't peak on average for 17 months. This goes back to 1988. The S&P 500 returned from the inversion to the bull market peak. Look at this, folks. That is a lot of gains for all of the fear mongering about the yield curve. Man alive. Now, this goes back to 1967. Yield curve inversion and S&P 500 peak. So if you go further back, you're only looking at about 11 months. S&P 500 peak and the recession 2 months after that. Sector performance before and after yield curve inversion. We talked about this last week. It's always good to review, folks. S&P 500 a year later, average return 8.2% since 1978. Good commentary here from Joe Politano of Aprecitus Economics. And this quote, I used to think that if there was reincarnation, I wanted to come back as the president or the pope or as a 400 baseball hitter, for those of you who know baseball statistics. But now I would like to come back as the bond market. You can intimidate everybody. That's awesome. James Carville. Some other good, commentary here. That's why I wanted to put it. Why? Because Everybody's got an opinion, folks. Let me show you the headlines. I mean, it's ridiculous. Everybody's got an opinion, and they're all conflicting. This is just this week when it comes to the yield curve. Look at the headlines. The bond market is flashing a warning sign a recession may be coming. Not all yield curve inversions are fatal. Bond market flashes recession signal as key yield gap inverts. JP Morgan, recessions don't typically start ahead of the curve inverting. So, I mean, there's so many headlines. They're all conflicting. And I think that's what James Carville's kind of pointing out. It's just everybody's on, pins and needles here. Bottom line, pins and needles. So good stuff there. Earnings are going higher. We talked about last week. Good stuff. And here's a chart that shows you. Some people like graphs as opposed to the, letters and numbers. And on the graph, you can see here's 225.22, looking at Q1 estimates, and they've been going higher. For Q2 as well, Q3, this is as of 325.22, and you can see they've been going higher, and Q4 going higher. You have sales as well. Those are the lighter shaded candlesticks. But the purples here are the EPS, and they've been going higher for every quarter. Again, that's why the market had found a base at the very least. And if you're worried about, well, what if earnings go lower? What if they decline? Folks, what if they disappoint? 49 of the last 50 quarters, earnings growth has beaten the consensus estimates. Look, if the market has 99 things to worry about, but earnings ain't one of them, folks. You need something more scalable to impact the earnings outlook. It's been this way since the beginning of the year. Our EPS estimates are trending higher. Unfortunately, the PE ratio, which is the purple line here, we had a derating cycle. Normal to be expected. Bond yields are higher. Normal to be expected. So don't get overly excited, folks, if all of a sudden we consolidate the gains over the prior 11 days. That would be normal. We have in May the potential for a 50 basis point hike, and something to be mentioned in the way of the Fed rolling off its balance sheet. If you think the markets are just going to go up from here, you might find yourself sorely disappointed. We're consolidating here now 2 days in a row into the end of the quarter. Look at your positions. Look at how much cash you have on the sidelines. Nobody knows what's going to happen tomorrow, next week, let alone by the end of the year. All we have are the probabilities. What do the probabilities tell you? How do they inform you to act going into the end of the quarter and as we enter a new month? Know your statistics. With that being said, I'm Seth Golden. Thank you for joining me this week in our State of the Market.